Yo, what's up guys? Welcome back to This Just In. Thank you for joining me today. In this video, we're going to do a Wish stock analysis. I've gotten a lot of requests for this one lately, so I wanted to give you my thoughts on their most recent earnings report. I will also go through and break down the fundamentals so that I can give you my Wish stock price prediction for the end of 2021. So let's jump right in. All right, guys, before we get started today, subscribe to the channel for me. Hit that little bell so you get notified every time I post. There's also a link down in the description to my Patreon account. Come over and join the family. We've got an awesome community over there. You'll get access to the private Discord where we talk stocks. You'll get links to all of my portfolios so you can see exactly what I invest into. And then anytime I buy or sell a stock, up to the second I do it, I send it out so you can follow along. I actually think the most valuable aspect, though, is all of the swing trade setups that I send out and all of the education that comes with it. So it can really help you really just take your investing to the next level and also make a lot more money. So if that's something you're interested in, come over and join us. I know you'll get a ton of value out of it. If you're not completely satisfied or haven't made your money back within, I don't really care how long, a year, a day, it doesn't matter. If you ever want a refund, just let me know. I'll refund you. My goal is to provide as much value as I possibly can, teach others, beginners that are trying to learn the stock market and how to invest. Because when I was starting out, there wasn't a lot of people there to help me except for YouTubers. So that's what I'm trying to do, guys. You don't really have a lot to lose. Come over and join us. You'll have an amazing family to grow and, take your investing journey with. And plus, we would love to have you. Day One Squad, I love you guys. Thank you for your support. It means the world to me. But guys, let's get started. In today's video, I want to go over the Wish stock. They just reported their Q2 earnings, and it was pretty bad. The stock sold off, quite a bit, like 20% in after hours. The earnings report was much worse than I think even they expected, the company at least, and an analyst expected for sure. So I wanted to go through that with you. Again, this is one of those videos where we're taking a top-down approach. We're looking at the surface level, looking through the fundamentals to see if it's something we want to take time to do a much deeper dive on. So pretty much what we'll do is we'll go through the earnings, we'll go through the fundamentals, we'll take a look at the chart, and then I'll give you my Wish stock price prediction for the end of 2021, and we'll go from there. So let's jump right in. All right, guys, first thing we're going to take a look at today. So this is the earnings for the most previous quarter. As you can see here, guys, their Q2 GAAP EPS was negative 18 cents, which was a miss by 4 cents. So that's not a massive miss on EPS, but nonetheless, still a 4-cent loss. Adjusted EBITDA loss of 67 million. The revenue was 656 million, which was only a 6.4% year-over-year decline. But they missed about 66.9 million on their analyst expectations. So like we've talked about in other videos, guys, we're in a real finicky earnings seasons right now. So any of these companies that come out, if they show any sign of weakness with, lower guidance or uncertainty or, missed earnings, they get pulverized. And so one of the big things here, guys, is they did not, send out any guidance. In their shareholder letter, the CEO said that they didn't want to give their normal guidance for the rest of the year because the earnings report was much worse than they expected and they need to make some huge shifts in the business. Now, the shareholder letter is something that has quite a bit of information in it. I recommend that you guys go through that. In today's video, I'm not going to go into that. Again, we're just going to look at the face value. But I do want to mention a couple of things from that. Just to kind of give you my thoughts on things that stuck out to me and what to look for. Now, guys, one thing I want to talk about real quick before I jump into those things that stuck out to me. From my experience with Wish.com, it's always kind of been negative. I don't know if you guys remember those memes that were on social media last year around Halloween when that kid ordered the It's costume of the clown. And then he posted a picture of the expectations versus reality, and it showed the picture of what the ad was, advertising for, what it was saying the costume looked like versus what actually showed up in the mail, and it was just not even close. I also had a really good friend that ordered it was his anniversary, and so he ordered this metal globe, or not metal, glass globe, excuse me, a glass ball where you send in a picture of you and your significant other, and they etch it on the glass, globe, and they shine a light into it. And the picture was beautiful. Like, it was so amazing looking. And then when he got it in the mail, it was like you couldn't even tell who it was, on there. So everything that I've seen from Wish has been really poor. They're almost like the 99-cent store of the e-commerce market, which I absolutely think that there is a huge market for that, guys. The value conscious consumer is a massive total addressable market. But one of the biggest issues I have is like the clickbait, the scams, the stuff like that. You don't see that type of stuff on Amazon as much, maybe on eBay a little bit, but I feel like the jump to e-commerce kind of neglected that value-based consumer that I think is a huge market, and Wish could capitalize on that. But because they've allowed so much scam, deceit, clickbait on their platform, I feel like it has made them suffer. Now, with that being said, you may have had a much different experience, and I will say that I would imagine that not everybody gets a scam product. There's probably a lot of people out there that order products and get the, product that was advertised exactly how it was advertised. Now, with that being said, the reason why I think that they have suffered because of that is because some of these numbers that have shown up in their last report. For example, guys, their user retention declined pretty tremendously. Like it went down a lot. Overall, they've got over 500 million downloads, guys, but in Q2, they only had 90 million monthly active users, which was down 22%. I want to say the last year, Q2 of 2020, they had like 110 million monthly active users. So big decline there, guys. The other thing is their last 12 months, their trailing 12-month active buyers were down 26% to just 52 million. So those are big declines, guys, in a really short period of time. I mean, seeing your monthly active users tank like that is not a good thing to look at. I mean, when we did the video on Fubo TV, their monthly active users was going up tremendously. Now, there's probably a lot of factors that play into this, and that's where your DD comes in, where you've got to go and do a much deeper dive. But again, at face value, guys, that is very concerning. Now, with COVID easing and more, retail stores starting to, open back up, and more people wanting to get out of the house and go out to stores, that could be a headwind. That could be why those active users are declining, because they're returning back to retail stores. I did hear Kramer on Mad Money a few days back say that he thinks retail is like, that's the way to go right now, that it's about to really kind of take back over. So we'll just have to wait and see. I don't have an opinion one way or the other. I will say, though, I do not like to see monthly active users decline like that. The next thing, guys, is installations fell 13% from just Q1. So 1 quarter later, almost a 15% decline in overall installations is really bad, guys. The other thing is average time spent on app. Guys, your not only does your installations go down, but the people that are even using your app already goes down by 15%, is what I think it was. That's not good, guys. I mean, I run a web design and marketing company, so average time spent on the site is a very important metrics. When you've got lower installations, but you've also got more people spending less time on your app, that takes your average, user that actually purchased something down exponentially. If these trends continue, that could be really bad, guys. Now, there is things that they can do to probably improve this, and I will say that in their shareholder letter, I did see a little bit about them taking some massive steps to kind of, rebuild their user experience on their app. But I think it has a lot to do with like the clickbait titles and the scammy ads and stuff like that. People are just fed up with it, and Wish has kind of built that reputation of really sketchy products. I mean, when you have a meme about your company that, it's advertised as one thing and you get something completely different, that's not good. You can go to YouTube and literally search in Wish expectations versus reality, and video after video after video will come up of people having very similar experiences. So give it a shot. Again, you guys may have had much different experiences, but that's just, what I've seen. So next thing, guys, is their digital ad prices have skyrocketed. They've gone up tremendously. And what that means is, a cost per click basis or a cost per acquisition, those prices have gone up tremendously. So when your ad prices go up so much, it lowers your overall marketing efficiency. So you're spending more dollars to get less ads. And if your numbers and your metrics are this bad, your marketing efficiency has just murdered you, because not only did your cost of revenue go up, but the same amount of money that you were once spending to get a certain amount of revenue is not even close to the same. You have to spend more to make less, and no company can sustain that. So something to keep in mind. Ad prices going up is the reason why I love Digital Turbine so much. That stock, APPS, one of my favorites. So if you've never heard of it, highly recommend checking it out. I've made a video about that one as well, and I will post that right here if you want to watch that. Next thing, guys, is their growth is set to decelerate in coming quarters. And I want to say all the way up until like third quarter of next year, it is set to go down while they're, continuously revising and fixing some of the issues and headwinds that they see. The other thing, guys, is again, with, the pandemic and so much unknown, that could definitely be causing a, constraint in supply lines, which could cause some issues as well. But with all of that being said, guys, let's jump in and take a look at the overall fundamentals. First thing we'll look at, guys, is the overview of the actual company. So currently right now, guys, the share price is $6.94. In post-market, it looks like it did go up a little bit and is currently sitting at $7.01. As you can see here, guys, their average 3-month volume is huge. They get a ton of volume, so the stock is perfect for trading, or swing trading, because it's not an e-liquid stock. It's very liquid. As you can see, guys, shares outstanding for the company is 628 million. For the ticker, it is about 558 million, and 66.49% of the float is available. Insiders hold about 10.24%. That's one thing that I really like about the company, guys, is their CEO actually owns a large percentage of the company, and historically, companies with CEOs that are much more invested end up doing better in the long run. So I really do think that their CEO can really step up and take this thing and turn it around, because if you guys remember, Snapchat back in 2018 was showing very similar type stuff. I mean, they were having a lot of issues in 2018 and 2019, so this could absolutely turn into a turnaround story, just like Snapchat did. Now, as far as institutions, they own about 17.68% of the stock, that's a decent amount. Market cap is 4.63 billion, guys. That's a large market cap. It's a mid-cap stock. Enterprise value, 2.83 billion. Price to sales ratio looks really good. It's only, it's less than 1, and that's really what you want to see. But they have a negative PE because they don't have any net income. And they also have a negative price to cash flow. And for those of you guys that watch, this channel, cash flow is very important to us, especially when we're looking at fundamentals on a company that has no net income. So gross profit margin, guys, really nice profit margin, 57.92%. The EBIT margin of 29%, but the net margin is really poor at negative 32%. So that's an issue. Return on equity, guys, 132% in the negative, with no return on assets. Not good to see. Revenue growth at 33.67%. Very nice revenue growth if they, can sustain that. But as we saw in last quarter, they did have a decline in their revenue growth. So we'll have to see how third and fourth quarter ends up. But like I said, they already kind of, guided for a deceleration in Q3 and Q4. So you're going to see revenue growth go down even further. And a lot of people are even thinking that revenue growth will continue until, Q2 and Q3 of 2022. So really, really not good, guys. Next thing we're going to take a look at, guys, is the income statement. As you can see here, we've got a couple of years of data, about, 5 years of data. Revenue growth is really good, guys. I mean, look at this, 1.1 billion in 2017, 1.728, 1.901, 2.541, and then 2.828 in their trailing 12 months. What did we talk about in the Roblox video and some of the other ones, guys? Revenue growth is great, but if you've also got cost of revenues, your fixed cost growing at the same rate as your revenue growth or more, that's not good. Their gross profit was really, really nice back in 2017 and 2018, but look at the deceleration in that gross profit, guys. Look at how fast their revenue is growing versus their gross profit. So as they're growing revenue, they are having to spend more and more on marketing, advertising, whatever it is, to maintain the same amount of revenue, same amount of revenue growth as they were before, and they make less money on that. And that wasn't just because of last year when ad spend went up tremendously. That's been going on for a couple of years. If we switch it to year over year growth, you can see here profit margin, gross profit from 2017 to 2018 was 61%. And it wasn't even a full percent the next year, and it was barely 10% the year after. So, really bad deceleration, guys, in gross profit, and really bad acceleration in cost of revenue. Look at the cost of revenue, guys, 35.6%, 59, 113. That's not what you want to see, because look at your revenue growth not growing nearly as quick. So definitely something to keep in mind, guys. You can see again right here, gross profit margin in 2017 was 80%. Then it was 83% in 2018, 76, 62, and 57 in their trailing 12 months. That's a big decline. So let's move forward. Next thing, guys, is net income. As you can see, they've never made money. They lost about 200 million in 2017, 208 million in 2018. 129, they were actually seeing they were seeing their net losses go up or down in from 2018 to 2019, and then it exploded in 2020, which again, I don't know why. That's something you'd have to look at on your deep dive if you really like this company and want to spend that time. But in their trailing 12 months, they've lost almost $1 billion, guys, and with those losses continue to roll, that cash burn is not good. Now that's not to say they can't turn it around, but again, you definitely want to keep that in mind. All right, guys, let's go ahead and take a look at the balance sheet because I want to say the balance sheet looks really healthy. As you can see here, total current assets is 1.69 billion, where the total current liabilities is only 858 million. So really, they could, pay off all their debt twice, and be just fine. With that being said, though, guys, they're running at a huge cash burn quarter over quarter, and from what I can see, they're really only about 5 to 7 quarters away from going under, essentially. So you're going to have to expect and plan for further dilution. If we take a look at the outstanding shares, guys, I mean, you can see here in 2020, they had they increased their shares by like 4 times, and then they issued even more in their trailing 12 months. So that's something that you're just going to see with companies like this because they need more money to operate. Unfortunately, from now until middle of next year, you're not going to see a lot of growth. But I did see in their shareholder letter that they're putting a lot of emphasis on cutting back their fixed cost and their marketing costs, because their marketing cost is what's generating the highest amount of cash burn. So just something to keep in mind, guys. You're going to get diluted further and further. But okay, now let's look at the cash flow statement. Take a look at what that looks like quarter over quarter, year over year. For those of you guys that do not know, cash flow, free cash flow is cash from operations minus capital expenditure. So you go to the cash flow statement, and as you can see right here, cash from operations minus capital expenditure. So back in 2017, they had positive free cash flow, guys. I mean, they did pretty well, 130 something thousand or million in free cash flow. But ever since then, it was negative, but it wasn't that bad. You can see, 94 million minus 20 million. So, 100 and almost 20 million negative in free cash flow in 2018, negative about 71 million in 2019, then about even in 2020. And I don't know what happened here in their trailing 12 months, guys. That's something you're going to have to look into. I don't know if they had an acquisition or what happened, because that's, $1 billion negative in cash from operations. Maybe they took on a loan or something. I don't know. You'll have to look into that. Now, that kind of threw off my numbers a little bit when I was doing my discounted free cash flow model. So what I did, instead of using the trailing 12 months free cash flow, I just took all of the years, averaged them out, and came up with a 5-year average or a 4-year average of negative 13.3 million, which is probably being a little bit generous, but nonetheless, I think that's fine. We can look at it with the 4-year average. So this is the discounted free cash flow simplified version of it. I put in all the data, guys. I put in the share price, outstanding shares, most recent revenue, most recent net income, and free cash flow. Now, this is what's hard about sheets like this, guys, about doing any type of assessment like this, discounted free cash flow model, whatever it is. You've got to make assumptions. Even when you're using valuation metrics like price to sales, price to cash flow, looking forward, you've got to assume what they're going to do. Now, I put in a growth rate for the next 5 years on their earnings at 10%. That's pretty standard. Maybe they'll do a little bit more than that. Maybe they won't. Who cares? I would rather be more conservative, especially with a risky company like this. As far as the terminal growth rate, I put about 3% after that. So what they're going to grow at in perpetuity after 5 years. And I put the discount rate at 10. That's just a standard discount rate. Revenue growth, I put it at 10%, which we can up that. We can definitely up that. The net income margin, I put it at 3%, or 30%, excuse me, because that's exactly what they're doing, even a little bit less. And that doesn't even affect our cash flow, assessment anyways, because we're looking at cash flow and not net income. Cash flow margin, guys, I put at 10%. They're negative right now. So that's being kind of generous, I think. And it gives me an intrinsic value per share at $9.40, which is more than where it's at right now. It's about 35% higher than where it is now. But guys, I mean, we're being very, very, generous with the 10% cash flow margin. If we up the actual revenue growth from 10%, let's just say 30% on their earnings growth, that does boost your intrinsic value pretty significantly. So guys, for me, I'm not ready to invest in this company today. I would rather see them get there because I think there's going to be a lot more negative news that comes out. Third and fourth quarter is going to be really bad. And I think that you're going to continue to see this company get beat down, because of all of that. Now, again, this could be a huge turnaround story. And if you've got a lot of conviction in the stock and you could hold it for the next 5 years, it could be a very good investment down at these lower levels, especially if you don't mind the volatility. I mean, you could absolutely see this stock, go from $6 back up to $25, $30, $40, $50 in the next 5 years, if you really believe that they're going to turn it around and start capitalizing on their strengths and, trimming down their weaknesses. But for me, I'm not quite ready to make those assumptions yet. I actually think that they've got a long ways to go and it's going to be a really bumpy road. I'm not a fan of the Wish website. I think it's kind of sketchy and I'm not down with taking advantage of people that are looking to have value. I feel like it's kind of predatory, preying on people that have less money that are looking to get a better price and then sending them a product that's not even close to what they advertise. I'm not down with that. So I think even if the company was looking better fundamentally, I still wouldn't invest into them just because of that reason. Now, if they change that in the future and get all of those scamming people off of their platform, then I would change my mind. But until then, that's what it is, guys. If you want to check this out, and you want to use this sheet, come over in the Patreon. It's there. You can use it all you want. But let's look at the chart. All right, so as you can see here, we've been in a downtrend for quite some time, guys. After the IPO, we did have quite a bit of red days in a row, but we did run up and we reached a high point of $32.85. So that's kind of what I'm saying, guys. I mean, why wouldn't the stock get back to those $32 levels? If they really do execute a perfect turnaround and the stock comes back or the company comes back stronger than before. Those are definitely the levels you could see again, in the coming years. So if you've got a lot of conviction in it and you can hold through the volatility, and you can stomach it, then yeah, you could see those prices again. Now, when? Who knows? But as of today, guys, you just broke a very critical support that you had to hold, guys. I mean, that's bad. You had this level here, guys, and if you would have held that, I would feel much better about it. But the fact that you just fell below it. Now, you did hold support back here on the 20th and the 19th. Right there at like $6.26 or whatever that is. But until you get back over $7.58, I want nothing to do with it, guys. Like, I would never buy this unless it gets back over 758, confirms it as support resoundingly. Like, I would need a spring, back test a spring and then a few different, confirmations to just show market participants that the bottom is in. Guys, when stuff like this happens, market participants are going to demand that you show confirmation. If you don't, it will continue to get pushed down. Look at Lightning eMotors, Rush Street Interactive, stocks like that, guys, that they went into price discovery, and until they were able to create confirmation, they continued to go to the downside way further than anybody thought they would. So that's not a good spot to be. Now, these are the most low risk levels that you could buy a stock at. Absolutely. You would want to buy it at the lows, but it could go much lower, and it's in price discovery. So one thing I will say though, guys, if you do pull your fibs from the first low to the all-time high, I mean, you did just hit a 1618, which is where major reversals happen. But you just fell below it. Now, I'm not saying that stocks have to reverse right at the 1618, and if they don't, then it's they never will. Sometimes they fall below it a little bit, or sometimes they reverse right below or right before it. But that's something you want to take into consideration, guys. The other thing is you did have MACD bullish divergence on your on your oscillator, but it underperformed in downtrends or bear markets, guys. Bullish divergence and bullish signals, they underperform. So you're gonna need to see some bids, guys. You're gonna need to see a lot of positive momentum move back into the stock before you really start seeing any meaningful moves. And I don't know if there's any catalyst coming up, like any positive news that's going to be coming out for the company. That's something you'll have to look into. You haven't really had any meaningful positive momentum on your MACD since clear back here at the end of June. So who knows? Maybe your negative momentum is waning. You are losing some of it, so you very well could pop back to positive momentum and and start trading up to the upside. One thing I will say, guys, is once you kind of break this 758 and hold it, you could very well go back to 1440 really quickly, just kind of like you did here. I mean, you can see how quick it moves to the top of the range. So you do have upside there. I mean, you got to fill this gap, you got to fill this gap, and most of the time gaps will fill. So again, these are the areas to buy. I just would wait until you get confirmation so that you don't see it go much further down. With that being said, guys, the next level after that would be that 1542. And if you break 1542, I think you'll see 27 really quickly. But I also think that you'll be stuck in this range for quite some time because of the way the company isn't really going to do much for the next year. And there's a lot of unknown. And again, I don't know if there's any positive catalyst that'll propel the stock. Maybe they'll make an acquisition or whatever. But I think the stock will stay depressed like this for a long time because they're going to need to raise more money. And when they do that, any gains that you gather from now until then could very well be just pushed right back away when that happens. So something to keep in mind, guys. I mean, you are at, pretty low levels of relative strength. If you look at it from this way, you do have, bullish divergence on your RSI, as well, I guess. One thing I will say, guys, is, I mean, you have this supply line right here. You've got to break that. Like, until you break that supply line, you're in bad shape, guys. You gotta break it. You gotta back test it, to start moving up. If you don't, you're gonna keep getting pushed down. And I actually think that the moving averages will continue to act as dynamic resistance, for quite some time until you get some meaningful price action. Again, guys, there is upside. There is potential, right? The way I see it from a long-term, investor position, that it makes sense to me. It makes sense to me because, like I said, Snapchat had that big turnaround story. They're doing $2 billion a year in revenue, so it's not like they haven't established that their business model works. I just think there's a lot of work to do for them to get there, and it's a little bit too risky for me to not believe in the company. I do invest in stocks like this that are, have fundamentals that are not amazing by any means or any stretch of the imagination, but I at least like the company a lot and think they are going to do well moving forward. In this case, I don't like the company, I don't like the fundamentals, and I don't like the chart. From a swing trade position, guys, from that aspect, there's so many assets out there that are so much better than this. Why would you ever try to trade this when there's assets that are making momentum shifting structures and they're presenting, really nice coinciding variables showing implied upside? This is not doing any of that. So again, guys, if you love it, go ahead. But for me, definitely not a buy right now. And who knows, guys, maybe that will change in the future, right? Maybe the stock will make a momentum shifting structure. Maybe it will create a 3 rising valleys or something like that. That will imply upside. But until then, guys, I'm going to stay on the sidelines. There could be a lot of potential in the stock because they are doing, $2 billion a year. So there is proof of concept there. I mean, people are obviously buying their product. They obviously have a decent business model in that aspect. I just think there's a lot more work to be done to get the company to a position that would intrigue me. But take it for what you want. Don't hate me for the analysis, guys. That's just how I feel. But this video is for entertainment purposes only, guys. I'm not a licensed stockbroker. Always do your own research and due diligence. Don't just take my word for it. Come join us at the Patreon if you want to be part of an amazing family. I'll see you guys in the next one. Peace.